Hi, everyone. Welcome to episode number 32 of the Atlas Annuity podcast. I am your host, Marty Becker, owner and founder of Atlas Financial Strategies in St. Louis, Missouri, where we specialize in safe money retirement strategies. In today's episode, we're going to talk about how annuity companies guarantee lifetime income annuities. Have you ever wondered that? Because it's not uncommon for people to say to me, this sounds too good to be true. In fact, someone just said that to me this morning. And my response to that is always, hey, look, it's not magic, it's just math. Now, I heard an interesting quote by C.C. Chang that goes something like, the greater the doubt, the greater the awakening. So hopefully this will be an awakening to those of you who really don't believe the income annuities will actually do what they're designed to do. Now, annuities are designed by actuaries. And if you don't know what an actuary is, don't worry because I didn't know what that term meant either. In fact, the first time I even heard that word was when I was on a first date in my mid 20s. And the girl I was with told me she was getting ready to go to school to be an actuary. And I don't even think she really knew what that meant because when I asked her, what does an actuary do? She said, all I know is that they work for insurance companies, they make a lot of money, and you have to be really good at math. Now, I don't know if she ever made it as an actuary because we never had a second date, but I have had the opportunity to meet a lot of actuaries since I've been in this industry. And I like to refer to them as pediatric neurosurgeons who hate blood because they're that smart. And if you're ever in the mood to meet an actuary, you can pretty much go anywhere in Des Moines, Iowa, and you'll eventually run into one because that's where the vast majority of them live, because that's where the vast majority of annuity companies are located. I have no idea why they're all in Iowa, but if you just walk into any random restaurant, you're probably going to see two or three actuaries sitting there eating a burger or something. Anyways, I wanted to start with a quick history of annuities to give you a background to show you this isn't some new idea or new fad. In fact, the first annuity can be traced all the way back to the Roman Empire in 255 AD, where a Roman judge named Ulpianus was the first person to produce a mortality table created for annua. Now, annua is just a Latin term for annual stipend, which were lifetime payouts made once per year in exchange for a lump sum deposit. After that, in the 1600s, tontines were issued to help pay for wars and public projects. And if you funded one of these tontines, you would get a lifetime income with the payments increasing every time one of the other tontine owners would pass away. Then, when all the tontine owners were gone, the payments just stopped. So it was probably a pretty good deal to be the last one standing because you were basically getting all of the money that all the other ones were getting at some point. Then, in the 1700s, the British Parliament authorized the sale of annuities, which became very popular in European society, or I should say European high society, because it became a form of prevention of these people ever falling from grace in their high society position, which is interesting because now, if you talk to any wealthy person, it's all about cash flow. Okay. Because you can always lose the big pile of money and assets depreciate, or they can appreciate, but they can also depreciate. So these people were worried about falling out of their social circle. So they always wanted to make sure, even if they ran out of money, they would never run out of income and they could still go to all the cool parties. It's always about cash flow, and it always has been about cash flow. Then in 1776, right here in the good old US of A, the National Pension Program for Soldiers was passed and signed into law with the Declaration of Independence, which provided a guaranteed income to soldiers and their families. Then in 1812, the Pennsylvania Company for Granting Annuities was founded, and one of their first clients was Ben Franklin. And in 1905, Andrew Carnegie started the Teachers Pension Fund, which eventually was changed in 1918 to TIAA, which is still around today. And then in 1935, FDR created the annuity that everybody owns, whether they know it or not, and called it Social Security. Now, although it's been completely mismanaged, it is still around today and is considered an annuity type payment. So, again, this is not a new idea. Okay. This isn't Bitcoin or leverage buyouts or anything crazy like that. These types of guaranteed lifetime incomes have literally been around for almost 2,000 years. It's no different than Social Security or a defined benefit pension, with the exception that life insurance companies do it a lot better than the government or pension managers. The reason life insurance companies, in my opinion, do it better is because they're for-profit businesses, okay? They don't offer these things because they're nice. They're in business to make a profit, and there's a lot of competition out there versus the government that is totally infected with corruption, and they force you to be in their annuity, which, by the way, they've been stealing from it pretty much since its inception to pay for other stuff. And the most recent numbers, unfortunately, are showing that Social Security is going to be insolvent in the next decade or so. And pension plans are just normally mismanaged, have unrealistic projected returns, and a lot of times are using outdated mortality tables and are not taking into account that people are living a lot longer, which is why you've seen stories in the financial media in the recent past about the Teamsters and the coal miners' pension funds having to get bailed out by the federal government because they were almost insolvent. Now, that is definitely not a shot at the union workers because those guys and gals paid into those pension systems their entire careers and they deserve that money. My point is that normally these pension funds are run by idiots and or scumbags. So only life insurance companies know how to do this and do it right. The reason being is income annuities are based on longevity risk. However, life insurance companies are on both sides of the longevity risk coin because they offer something called term life insurance in case you die early. Therefore, they have a natural hedge that protects them in a way no other industry is protected. And this has everything to do with something called mortality credits. Almost all of you own or have owned mortality credits at some point throughout your life. Now, have you ever wondered how a life insurance company can guarantee a 25-year-old $1 million if he accidentally steps in front of a bus and gets killed, and can make that guarantee to him for only $30 a month? It's because they know a lot of 25-year-olds are not going to get hit by a bus and get killed. The risk that a life insurance company takes when they sell a term life insurance policy is that you will die too soon. The risk they take when they sell a lifetime income annuity is that you will live too long. But because they are on both sides of the same risk coin, they can neutralize that longevity risk of the income annuity. So let me give you an example to clarify what I mean. So let's say the average person out there starts to live to 120 years old. Okay. The insurance company would be paying out the income longer, but they wouldn't be paying out as many death claims because they would have gotten all their money for the term life insurance policies already and they would have expired. And vice versa, if some sort of global catastrophe happened and people were wiped out in large numbers, then they would be paying a lot of death claims, but they wouldn't be paying the lifetime income annuities. So this is all about mortality credits and the next point, which is risk pooling. Now, risk pooling is taking your money with a bunch of other people's money and applying the law of averages and the law of large numbers. You see, these actuaries know how many people will live to a certain age. They just don't know which people will live to that certain age. So this is why the payout rates are a lot higher when you're older, because you're bringing less longevity risk to the table. The next factor that plays into these income annuity pricing is interest rates. So at the time of this recording in June of 2024, we're in a high interest rate environment right now. So annuities are paying more on a guaranteed basis than I've ever seen. Now, if you're listening to this at some point in the future, don't get discouraged, because even when rates were at an all-time low, you could still get way more guaranteed income than you'd be able to safely withdraw from your managed portfolio. So it's a factor, but it's not the only factor. And also concerning the interest rates with the law of large numbers is the annuity company can get a better return on their bond portfolios than you or I could as individuals, because they're doing it with billions of dollars, and they can hold those bonds a lot longer than you or I could personally. Then the last factor that plays into how these work and how to get the highest guarantees out there for your particular age range is something called capacity. So when an insurance company gives us these quotes on the guaranteed income, they have a limited number of mortality credits that they can offer for different age ranges. So that's why you may see one company being the top paying for a 65-year-old, but they're nowhere close to being the top paying for a 60-year-old or a 70-year-old. And then if you check a week later, that company may not be in the top 10 because they've reached their capacity for that age range of the 65-year-old. But then what happens is another company pops up and takes that place. And this is why it's vital to work with an independent advisor who can check using third-party software who is going to give you the highest income at any given point in time. Because like I've said 100 times before, I am completely agnostic to these companies. I don't care who we use as long as they're financially stable, they have good customer service, and they're going to give us the highest guaranteed benefit available at that time. I don't care about getting bonuses or winning trips for placing all of my business with any one company. And I prove that because I do use actually multiple third party softwares that compare all the top paying companies right next to each other. In fact, this year alone, I have placed business with 11 different companies because the top payers keep changing. So I don't care who we do business with as long as they meet the criteria that I just mentioned. So, a quick summary of what we just talked about. How do annuity companies guarantee lifetime income? Number one, mortality credits. Number two, risk pooling. Number three, interest rates. Number four, capacity. So, that's about as much of a 30,000-foot view as I can give you, because anything beyond that, you're actually getting into the actuarial math. And if you're the type of person who needs to know and understand how all that works, don't call me. I guess go take an actuarial course online or go walk around Des Moines, Iowa and see if you can corner one to teach it to you. However, what you should call me about is to get your questions answered and how to get the most guaranteed income using my Atlas annuity strategy, which you can do by booking a short phone call by either clicking the schedule a call button in the top right corner of any page on my website or by going directly to atlasannuity.com. And if you're finding this information helpful, please like, subscribe to, and share this podcast with someone that you think would find this information useful. And if there's a topic that you want to hear me talk about, please leave a comment on the website or in the comments section on YouTube, and I would be happy to take that into consideration to make a podcast on. So anyway, I want to thank all of you for joining me in episode number 32. Again, my name is Marty Becker, wishing you all the best in your financial education, and we will see you in the next episode.